Hey guys, welcome to the Doe Show. Happy Wednesday. It feels weird. Should be like a Monday, right? Well, hey, listen, I'm going to get right to it today. There's a lot going on, and just so you know, I'm going to be posting a lot more here in the coming days, and I have been sort of communicating more with our customers to let them know about this market. We are financial advisors here at Jazzwealth. If you're watching us here for the first time, basically, we help you with your retirement accounts, your long-term investments, and it's been scary, right? And I understand that some people are scared, and so rather than just say, oh, it's okay, you're going to make it through it, right? That's what every other advisor is doing, if you can get in touch with them, actually. What we're doing is saying, okay, here's where we're at, here's what we're going to expect, here's how we're going to adjust if we have to. We're getting kind of lucky, we may not have to, but I want to give you the education, the history, the stats, help you understand this stock market so that you understand where you're at and what to expect there. So if you want that from an advisor, I'll just ask you, give us a shot here at Jazzwealth. At worst case, you could stay tuned. I will post a lot of the videos publicly, but then when we get into details, I have to share that only with our customers. You understand. Well, today I want to talk about the stock market being discounted. Everybody on the planet knows the stock market is discounted. However, you may not be using that word. You may be using the word that it has crashed. You may be using the word that it is the economy is in a recession or going towards a recession. You may be using the words bear market. You are not using nice words, whereas I'm saying over here, the economy is trading at a discount. And the truth is, if we could get everybody to think that, you would be a lot better off if you invested in every dip. Think about what every book says. You read books on all the guys that you like to admire, investors or motivational speakers and such, and they all tell you, buy when the markets drop. Of course, it's easier said than done. So let's talk about the markets dropping and if this is a good discount. Here's the thing. When the markets fall, we see the price fall. Right? We can see that it's trading at a discount, but there's other ways to value it as well. And I'll use a really simple example that hopefully everybody can understand. Have you seen Shark Tank? Have you seen the show Shark Tank? Now, I can't name all the sharks. I was trying to look up the one before I started, but here's what we'll say. If you've seen the show Shark Tank, you know that people go in and they offer part of their business up in exchange for a partnership of some equity stake or whatever they come up with. Now, you've all seen, and I'll give an example of a guy that walks in and he says, I'm offering this product, and I am seeking today a $50,000 investment in exchange for 10% of my company. So we've all seen that part, right? And so inevitably, the guy in the middle, I can't think of his name, I was trying to figure this out. The bald guy in the middle inevitably says, if you are imputing a $500,000 valuation on your company, right, because the guy wants $50,000, for a 10% stake, which means he thinks 100% is worth $500,000. The bald guy will always say, if you are imputing a $500,000 valuation, you better show me some sales, right? And the people usually say, yeah, we have some sales. And so in our example, we'll say, yeah, I have sales of $100,000 since we started. And so let's say I started this year. I think my business is worth $500,000. I have $100,000 in sales. Now, the bald guy in the middle always says, yes, but out of the $100,000 in sales, how much did you keep? What was your earnings, right? And I promise I'm getting somewhere. So then the person might respond, well, we have $10,000 in earnings. So we sold $100,000 in goods. We have $10,000 in earnings. And the bald guy in the middle always goes, you're crazy. You think I'm going to pay 50 times what you earned to invest in your company. So what happened there? The simple explanation is the person on the show thinks their company is worth $500,000. They only earned $10,000 in income. And so what happens is, if the bald guy in the middle, Kevin, his name's Kevin, if Kevin invests $50,000 for 10%, it means that Kevin has to invest $50 in order to participate in $1 worth of earnings, 50 times the earnings. And so he will usually go crazy. Now, Kevin in the middle, he always looks back in time. And Kevin says, well, your earnings were only $10,000. Naturally, the people on the show go, yes, but we have a new deal with HSN. We have a new deal with Walmart. We've got this thing coming up. And so we should do $250,000 in sales this year. And so Kevin, in the shark there, he's always like, yeah, but that means I have to take that risk with you, and he gives all this explanation, right? Kevin O'Leary, thank you so much. And so Kevin will get upset. What always happens? Mark Cuban down on the end, if it's something he's interested in, he will go, oh, you know what? It doesn't matter. If 50 times earnings is nothing right now, because if you really do have those contracts with HSN and with Walmart and everything, then it's a no-brainer. I'll make so much money off of it, it's worth it to pay 50 times your current earnings. So Mark Cuban's always looking in the future. Kevin O'Leary's always looking backwards. Well, you can do that with stocks as well. You can actually look at stocks and say, how much do I need to invest to participate in $1 worth of earnings? And then we can start to see if it's too much. Now, I ask you the question. In the example that I gave, 50 times earnings to participate in the Shark Tank story there, is that too high? Right? Generally speaking, is 50 times previous trailing earnings, you usually see that word, trailing 12 months earnings, is that too high of a price to pay? In other words, is it too much to expect someone to invest $50 in this company in exchange for $1 in earnings? Now keep in mind, it's per year, right? So the earnings we're talking about are yearly earnings. So if you invest $50 and you get $1 in earnings back a year, it's going to take you 50 years, all things remaining equal, to get your $50 back, right? So does that seem a little high? Well, here's the thing. When you compare it to stocks, you actually can compare them to other investments. And I'll give you a great example. I did this just a second ago, so if the number is wrong, I'm so sorry. I just pulled this up. UPS. I was trying to find companies that we've all heard of. Currently, if you invest in UPS, you would have to invest $15 in order to participate in $1 worth of earnings. Meaning if the stock price didn't fluctuate and all the company did was just continuously make money, you would invest $15. They would give you $1 a year in earnings, or that's your projected return. That sounds pretty good, right? Because the Shark Tank example I just gave you was 50 times. Well, now we've got comparables. Now we can say, well, UPS is 15 times, or we would say it has a PE of 15, meaning its price relative to its earnings is 15 times, okay? So, 15. Is that a good deal? Sounds better than the 50 a minute ago. Well, now what we could do is we could say, well, there's another company that competes with UPS, and it's FedEx. So FedEx, what are you trading at? Meaning if I invest money with you, how much do I have to invest in order to see $1 back? And so FedEx is actually trading at 13 times earnings. So picture FedEx in the Shark Tank and picture UPS in the Shark Tank, and old Kevin down the middle, he's going, why would I pay 15 times earnings when you're offering the deal to me at 13 times earnings? Does that not seem like a discount? Well, it really does. Here's the thing. UPS, if you dig deeper, they've already made a lot of their money. See, their earnings were higher by about 40% this year. They're not projected to be that high next year. So you're taking a little bit of a gamble that something good's going to happen with UPS. FedEx's earnings fell. Their earnings actually fell 2%. So while it seems like a discount, their earnings are dropping. You don't know if that stays true going forward, so you're taking some assumptions there. Nonetheless, you can compare the two. The whole moral of this entire story was to say we can do that for the entire market. We can look at the Russell 2000, the NASDAQ 100, the S&P 500, and we can say, is the S&P 500 trading expensive, or is it trading cheaply? Not the price, not the price that you see fluctuating all around the place. I'm talking about as a package. Let's say the S&P 500. All 500 stocks. If we invest in the S&P 500 now, how much do we have to invest to participate in $1? And if we do invest, are we investing at a discount? Like, have we seen that number be higher or lower? And that's the real question. Now, since it's a man-made index, the S&P 500, we don't have anything to compare it to. We can't compare the S&P 500 to the Russell or the NASDAQ or the Dow because they're all completely different man-made indices. So what we can do, and what most analysts do, they say, okay, let's take the S&P 500. What is the current price to earnings, history, not looking forward. We're going to be Kevin O'Leary in this example. What is it? And is that trading at a discount? So stick with me here. If you're still awake and you're still paying attention, check this out. Here is a chart of the S&P 500's price to earnings. Meaning, if you invested, how much, again, did you have to invest to participate in $1? Did you have to invest a lot or a little? And how does it compare to history? So look at the chart there. Here, this goes all the way back before the 1900s. This is from Robert Shiller, by the way. This is not my chart, so give some credit there. It's from his, he's an economist, and you don't have to like him, but he's got a lot of data. So here's the thing. So here is a chart looking at the entire history of the price that you have to invest relative to the earnings. And currently, well, if you take out today, so we're right around 18. A little under 18 is the actual number today. So you would have to invest about $18 to see $1 worth of earnings. The real thing we want to look at is the average. The average is actually 15.73. Did I lose it there? Let me see. It's coming. I think it just disconnected for a second. There you go. So the average is 15.73, meaning you are basically paying close to the average for this company, or for the S&P 500. So you don't have to wonder, am I paying too much? We were at 24, 25 earlier in the year. So you'd be paying 24, 25 times earnings to participate in $1 worth of earnings, of course. I don't have to say that anymore. You got it. So what we're seeing now is the stock market has fallen. Prices are coming down, but also our valuations. Valuations are coming down in the most simplest term possible. If you understand what I'm talking about and you're more detailed about it, of course you know I'm trying to simplify this for the masses here. But so here's what we're looking at. You not only have a market that is discounted relative to itself, but the price of the stock market is falling as well. Now, if you look at this, you could even make an argument that you are getting valuations that are the lowest they've been, almost the lowest they've been, nearly 30 years. You go back here, this is mid-1990s right here. This low, of course, was just after 2008. But you're headed to those price levels that you haven't seen in a long, long time. So this further justifies the headache that sometimes it takes to invest in the stock market, the sort of pressure you have to go through, the stress you have to see on TV. I hate how they always focus on the negatives on TV. But you're actually able now to compare the past to what's currently going on and see where you stand. This is the stuff I love doing because by showing this to you, it's not an opinion. The fact that I think the markets are bouncing here and will bounce, and I was tweeting all night last night and all morning about it, is an opinion, right? I can give you the data. I like to put some data in there. But now you look at this and you go, okay, I can justify a discount. I promise you Warren Buffett right now is buying up all kinds of good stuff, and it's going to show that he likes this discount. So just wanted to kind of share that with you. I know it's a little bit, I tried to keep it really simple, really basic there, but it can go, we can go a lot more detailed into it, of course. Nicole says the discounts are hard. It's hard to wait. I agree. The question is, how long do you have to wait? So I tweeted this out earlier that out of all of the bear markets in history, ready? All the bear markets in history, 54% of them recovered in less than 1 year. So half the time you don't even have to wait a year. So that's just one little bit of data. I will refer everybody to the Twitter box to check out our what we've been tweeting. I'm trying to give you guys data and information so that you know what to expect. And I'm really hoping in every one of these videos, I'm going to suggest that if you've been through this before, leave a comment down below to let somebody else know it's going to be okay, because some people have never been through this before, and I'm sure they're very nervous. I want to make sure they get the help, not only from me, but if you can chip in too, that'd be great. Eric's hoping for the end of the year, no end of the year rally, wants it to hold off. Well, take a look back at some of the videos we've done to show how far along the bear markets are at the point that they hit the bear market. Take a look at the how they perform the quarter afterwards. You can get a lot of useful information from that. I know it's a little geeky, but I think some of you guys like to see it. It's a little comforting and so on, so I'll keep doing it. Oh, individual stock PEs. Yeah, Nicole's all over it. Yep, you got it. Tons of them. I thought about running a report so we could see where everything lands. I like it. little by little putting money in the stock market over the last 2 weeks. Yep, even if you have to turn the other way, right? You know it's going to be okay. You know it's going to work out. Ryan's got the right idea there. I love it. Hitachi, well, that's the problem, Eric. You're looking at Hitachi. Adolfo, should I cash out my 401k? Absolutely not. No, no, no. The fact that you're scared or you're concerned is not a reason to cash out your 401k. You may find that there's a tweak or an adjustment you want to make there, and also do not go from investing somewhat aggressive or aggressive to conservative. Please, please do not do that. I made a video on that as well. My job is to pull all of you kicking, screaming, all my customers too, of course, my customers, I'm going to make sure if they're kicking, screaming, nervous, yelling, frustrated, scared, can't look, can't talk, right? My job is to pull all of you through it, but I'm not going to pull all of you through it by just saying, hang in there, it's going to be fine. No, I'm going to give you what you need so you can see, oh, this is not as bad as TV makes it seem. This is as bad as everything's making it seem, but here's what we can expect. I'm going to pull all of you through it. If I can get you all through one of these cycles, then the next time it comes around, it won't even faze you, I promise. Good stuff. Okay, hey, that's all I have for you at the moment. We're going to be back for the closing beat later today at 5 o'clock. If you don't know, that's a show that we do at 5 o'clock Eastern every day to go over the stock market, the good, the bad, and the ugly. I have so much that I want to cover today because, like I said, last night you saw the Asian markets swing to positive, and right there, I tweeted the second I saw it because you know that was the start of this whole thing, at least a temporary bottom here. I don't know it's the bottom forever, but this today is a technical reversal that officially marks the low, at least in the short term here. So we're going to cover all that. Don't you worry, we'll be there, and I appreciate you watching. I'll see you later.
Why should you choose Jazzwealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.